moving along to retirement. Retirement saving is not a whole lot different than saving for your kids' school. Save early, save often, then you don't have to save as much, or you'll have a lot more to work with. So, when you get that first job, start saving into into an IRA or your employer's 401k or 403b plan, even if it's only $50 or $100 $50 or $100 a month, just to get into those habits of, like Stuart mentioned earlier, paying yourself first. Once you get all of your consumer debts paid off of credit cards, cars, that type of thing, non-mortgage debt, then try to get your try to get your total retirement savings to around 15% of your household income. I prefer the Roth IRA option or the Roth 401k option, so you're contributing after-tax money into those, and then those investments grow tax-free. And so when you take them out, you don't have to pay taxes on the growth compared to the traditional ones where you're going to pay regular income tax rates when you start consuming that money when you take it out. So,
and it's important also to keep in mind that we keep our priorities straight. So for instance, you have a kid going to school and you've got a nice IRA or a nice 401k or some nice retirement asset out there, and you're thinking, well, I'll use that for school. And there are some exceptions that the IRS allows you to do that, but we would caution you on that, because you should keep your retirement money for you for retirement. The way I explain it to clients is that if your kid goes to college and they need to finance college, they can. There's options. Banks will give them loans. But when you show up for retirement, you don't get to go to the bank and ask for a loan to retire. That usually won't work out well. So.
Yeah. As an example here, 75. If you're contributing $75 on a biweekly paycheck, you earn an 8% return. Started at age 22 through age 65, kind of the average professional working. And, $75 might be a little much when you're starting out. It's probably not very much by the end of your working career. And so you can see the future value of $734,000, which would be, substantially more than, what probably 98% of Americans have. But the big difference there is that person started really, really early. 43 years of compound interest is why that person has accumulated a lot of wealth. It's not so much the dollar amount that they saved total, it's the duration of time that they did. I'd also caution you from taking out 401k loans or 403b loans, because if you do that, if you have a $10,000 or $15,000 401k loan, and then you change employers, get fired, business closes, whatever, that 401k loan is due 60 days upon you leaving the company, or it gets it counts as a or an early distribution, and you're going to pay income taxes plus a 10% penalty on that. So,
yeah, absolutely right. I would agree. I think the other thing that we like to drive home here is that the most important resource you have in your life, in this world, really, is time. And I think this illustrates it perfectly.
Yep. When it comes to insurance, you want to review your, property insurance on a regular basis and make sure that you've got the right amounts, that you are protecting yourself and your assets. You don't really want to be overinsured. Definitely don't want to be underinsured, because insurance is, it's like a utility bill. It's going to cost you money, but you want to work with a professional that has got it's been doing it a while, knows what they're doing, and they're also a teacher, so they're not just telling you this is why you do it, just trust me. You want to have a good understanding of why you do it. One of the things that we frequently see people that they don't have that they really, really need is umbrella liability policies. They're dirt cheap, and they give you so much protection, especially when you get to the point where you have saved up and you do have a nice nest egg and have acquired some wealth. For the cost of those, it's very, very inexpensive. And also, the other thing that people causes a lot of confusion is life insurance. You know, myself, got 3 kids, mortgage, wife. You know, I've got $500,000 of you know, roughly 30-year term insurance because I will not have a need for permanent insurance. You know, when I'm 64 years old, I can promise you I will not have any kids living in the home. And you know, we will should have the house paid off and some investments in the bank. So if something does happen to me, my spouse would be fine, and vice versa. So you know, the purpose of life insurance is to replace one's income. So there's very few instances where permanent insurance is a good fit for someone, and that's again where you talk to your financial planner, investment advisor, an accountant, and attorney to all get some input from them to see if what makes sense. So
that's sound advice. Yeah, a lot of times we'll run into folks who talk to a life insurance salesman and they bought it as an investment. Life insurance shouldn't be treated as an investment. It should be treated as insurance. That's what it should be. And yeah, you said it right. It's good to bring in the whole team to talk about it.